Hello, everybody, and Happy New Year. Welcome back to Okcoin Live. So, we've had a brief hiatus with Okcoin Live during the holiday season, but we're so excited to be back here today talking to you. As you might know, typically an Okcoin Live episode is either the listing team just riffing amongst themselves, or it is us interviewing token projects that we're either very excited about and or are listing. Although that is still a core part of what we will be covering on Okcoin Live, we decided to switch it up given all of the news that's been happening in the crypto market recently. You might have been hearing about the collapse of FTX, or about the word SBF or FTT, or CZ or Binance, or just crypto prices crashing. And we just wanted to come here today and explain some of the hard facts of what has been happening in the crypto news recently, specifically around FTX. So as you might remember, my name is Devika. I lead listings for Okcoin, and today we'll be having Sam on the listing team join us. So welcome, Sam. We're really excited to have you here today.
Yeah, happy to be here.
Awesome. So we're going to be talking about, again, just the hard facts of what's happened with FTX, what the news was, what the timelines were, and this is not the place for sensationalization, but really for understanding what happened in a very clear and concise manner. So Sam, why don't you kick us off?
Thanks, Devika. Yeah, as she was saying, there's a lot of stuff going on. Let's just start from basics here. Let's start about what is a centralized crypto exchange. A centralized crypto exchange is a digital platform that allows users to buy and sell cryptocurrencies. The exchange is run and managed by a single company or organization, since they typically require users to deposit their funds with the exchange in order to trade. Some examples include Okcoin, OKX, Binance, Coinbase, and formerly FTX. By contrast, on a decentralized exchange, users typically control their own funds and are responsible for managing and securing them themselves. On a decentralized exchange, trades are typically executed directly between users using smart contract code, whereas on a centralized exchange, trades are typically executed by the exchange's own matching mechanism, which uses algorithms to match buy and sell orders. Centralized exchanges are often easier to use and easier to navigate as well compared to decentralized exchanges. They give users a more user-friendly experience typically as well. Additionally, centralized exchanges can offer a wider range of features and services, such as support for fiat currencies and staking services. And it's all accessible all in one place, a little easier UI there. Let's talk about something a little more granular that maybe not as discussed as much in licensed exchanges versus unlicensed exchanges. A licensed crypto exchange is one that's been granted a license by one or more regulatory body of a particular region. Those regions include examples such as the United States, Singapore, or the US. And these are licenses that allow them to operate as cryptocurrency exchanges. This involves meeting certain requirements and following various rules and regulations. In contrast, an unlicensed crypto exchange is one that does not have a license from a regulatory body to operate as an exchange. These exchanges are still able to operate, however, they may not be subject to the same level of oversight and regulation as licensed exchanges are. So let's talk about some of the entities involved in this saga we're talking about. Let's first talk about FTX and FTX US. FTX was a Bahamas-based unlicensed crypto exchange founded by Sam Bankman-Fried, or SBF. You've probably heard that. SBF, FTX, all those acronyms thrown around quite a bit. FTX specialized in derivatives and leveraged products. According to FTX's website, FTX US is a separate trading platform and not owned by FTX. Alameda was a quantitative trading firm that was also founded by FTX co-founder SBF. So SBF founded both FTX and Alameda. According to Forbes, it once had trading volumes of about $5 billion per day. It also provided liquidity in various crypto markets.
So let's move on to ask, what is the relationship between FTX and Alameda? Other than SBF having founded both companies, the public understanding was that there was a separation between the two entities, which is Alameda and FTX. However, on November 2nd, Alameda's balance sheet was leaked, revealing that it had a large amount of FTT tokens. The balance sheet showed that Alameda's holdings consisted of $3.7 billion of unlocked FTT, which is liquid FTT tokens held as regular assets, and $2.2 additional billion of FTT tokens pledged to creditors as collateral for loans that they had taken out. Now, FTT was FTX's official token and could be used to get trading fee discounts and staking rewards from FTX. The presence of FTT tokens on Alameda's balance sheet gave some people the impression that despite the purported independence of both entities, the performance of FTT, and thus of FTX, may have been related in some way to Alameda's balance sheet and their performance. According to CoinDesk, approximately 40% of Alameda's reported $14.6 billion in loan collateral and other assets consisted of FTT tokens that FTX had issued themselves, not other fiat or independent cryptocurrencies. Basically, according to the leaked document, billions of dollars of Alameda's value was held in tokens that was created by FTX, which had no other real collateral or backing. So, let's talk next about the subsequent price drop and bank run on FTX. The large amount of FTT on Alameda's balance sheet brought forth some criticism that FTX and Alameda's relationship may have been more codependent or symbiotic than previously assumed broadly by the public. So when the news broke, there was plenty of criticism on crypto Twitter, but not a huge change in price on FTT. However, a few days later, CZ, the CEO of Binance, tweeted that Binance would be selling its $2.1 billion of FTT tokens, which may have contributed to the decrease in value of FTT by over 80% over the next 3 days. As the value of FTT fell and fears of losing their funds mounted, the market panicked and users started pulling their FTT tokens off FTX and also other tokens off FTX, causing over $6 billion to leave the platform. FTX halted withdrawals on November 8th, even though SBF, in a since deleted tweet, said that FTX had sufficient cash reserves to cover client holdings and that they did not invest client assets.
By November 8th, the price of FTT had fallen to less than $6, and billions of dollars had left the FTX platform. However, despite his earlier assurances that FTX had enough to cover all client holdings, SBF later tweeted that, pending due diligence, Binance and FTX would work on a strategic transaction to help clear out liquidity crunches. CZ and Binance expressed interest in FTX, even signing a non-binding letter of intent on November 8th for FTX to be acquired by Binance. However, after purportedly performing some due diligence, Binance decided not to further pursue the transaction.
So let's take a step back now and ask, what is a margin trading position and what is a margin call? Now, at a high level, margin trading is a way for investors or investment firms to trade securities by using borrowed funds. That's funds that are not their own. When an investor or a firm opens a margin trading position, they're essentially borrowing money from creditors, which is more than they may have been able to purchase with just their own money. This can be a risky strategy because if the value of the collateral used to borrow funds decreases below a certain threshold, the investor or the firm may be required to provide additional collateral to the creditors in order to maintain their margin trading positions. If they are not able to provide the additional collateral, they may be required to close the margin position and pay back the creditors. This is called a margin call. So, was there an Alameda margin call? According to CoinStats, Alameda allegedly had a large margin trading position. And as FTT, which FTX's balance sheet confirmed was one of their largest sources of collateral, began to fall in price due to the news, Alameda allegedly began receiving margin calls from their creditors.
On November 9th, anonymous sources alleged to the Wall Street Journal that FTX had lent billions of dollars worth of customer assets, more than half of its customers' funds, to Alameda, a sum amounting to about $10 billion. Now, this report alleged that Alameda was using FTX customer deposits to trade in crypto markets. Although there's still a lot to uncover throughout these ongoing investigations, the combination of margin calls, huge customer withdrawals, and the price and drop in price of FTT, and as well as other factors, appear to have contributed to the many problems facing FTX and Alameda.
So what was next? Bankruptcy. Alameda, FTX, FTX US, and more than 100 affiliates tied to FTX.com filed for bankruptcy on November 11th, 2022. On December 12th, 2022, SBF was arrested in the Bahamas. Following SBF's arrest in the Bahamas, SBF was extradited back to the US to face potential charges. And in the latest news, it's been noted that SBF may have posted bail in the US and may be currently under house arrest. So, as we think about what's been happening, and as Sam mentioned, this is an ongoing investigation, and there is still a lot that we don't know and we are waiting to uncover. We hope that through this short exercise and through the slides and the voiceovers, you were able to get a short and brief and clear understanding of the news around FTX and SBF in the last 2 months. If there's any questions that you may have, please feel free to reach out to any of us on Twitter, Discord, or any other channels. We're happy to answer any questions to the best of our abilities and provide you with any of the hard facts that we are able to gather. Thank you so much for joining us, and we hope you join us for future episodes as well.